In fact, you're the limited partner. General partner is the federal government. No idea how much they're going to take from you. Being in the insurance industry is a terrible job if you just want to make $30,000 a year. I wouldn't do it. I'd go change tires at Discount Tire. If you don't want to make, six-figure income, I don't know if this is what you should be doing. Once you make a certain amount of money, what do you want to be, the richest guy in the cemetery? Or do you want to live the richest life? I want to be in control. I want to have tax-free income in retirement. And that 401k and that IRA, those are going to be like chains around people's necks. They're going to regret that they put as much money in those products as they did.
Never short stopping, now I'm winning like I'm G'da. Steady through the rigor.
So my guest today is world-renowned, most highly requested speaker to train on this financial concept and financial strategy called annuities. So with us is Tom Hegna, which I also learned earlier today that he's also a retired lieutenant colonel serving in the Army.
Yep.
So welcome to the Seven Figure Squad. I'm glad that you're here. Welcome to our conference.
Yeah, no, it's a great conference, and thank you, Matt, for having me.
100% glad that you agreed to do it. This is an area that a lot of people may not know a lot about, because I remember when I first entered the life insurance business coming out the military, I could barely spell annuity, let alone annuitization.
Right.
And so why are annuities so less known as compared to other 401ks and pensions?
Well, I think the baby boomers, know at least a little bit about annuities, because you've got to take that longevity risk. As I said out there, longevity is not just a risk, it's a risk multiplier of all the risks. Because the longer you live, the more likely these other things are going to happen. And the annuity is the only product in the world you can buy that will guarantee you will never, ever run out of money. And running out of money has been the number one concern of people ever since there's been people and been money.
When I first entered the insurance industry, I had to get both a life insurance license and a Series 6 license. And I quickly recognized, because this is the first world I entered in, I needed both licenses. I recognized too that when I went to conferences and went to MDRTs, that certain guys just got recruited into life insurance. And certain guys just got recruited into the wirehouses and the brokerages. And they had their own opinions about each other. Like Wall Street would fight with Main Street.
Right.
Why do you think that dynamic happens?
It's unfortunate, and what's really unfortunate is some of these Wall Street people call themselves fiduciaries, but they're not recommending annuities, they're not recommending life insurance, they're not recommending long-term care insurance, so I call them fake fiduciaries. Because if you're really going to act in a client's best interest, you have to be in their best interest no matter what happens. If the market crashes, or if they live a long time, or if they die tomorrow, if you just have a stock portfolio, that's not going to protect your family. If you live too long, you're going to withdraw all the money out of the stock portfolio. So you need to have insurance-based products if you want to have an optimal retirement. You can have a retirement without it, but it'll be suboptimal, less than what it could or should be. And so if they want it to be optimal, and these fiduciaries who say they're acting in the client's best interest, why would they want to build suboptimal portfolios? I still haven't figured it out yet.
Tom, there's so many different ways you can strategize and plan for your finances. Especially today with TikTok generation, I call them, Gen Zs, Gen X, the millennials and the baby boomers coming up. And a lot of them get confused because they see it's so well marketed at how you can put your money into crypto.
Yep.
I made $1 million selling a cartoon image called an NFT, and this and that. Was so much confusion. And I'm sure as you've been coming up in your days, there's also a lot of confusion too as well. How do you cut through all the riffraff?
Well, what's funny is I did a positive post on crypto a couple years ago, and I got all these, "Oh, Tom, you've been hacked. You would never say anything positive about crypto." And I said, no, because I've got my basic living expenses covered, because I got life insurance going to my family, guess what that frees me up to do? Take a little more risk with some of my other money. And I was the biggest Bitcoin non-believer for years, because, it's nothing. It's the greater fool theory and all this. But I watched CNBC a couple years ago, and there was a guy on there who convinced a non-believer like me that Bitcoin could hit $1 million. He said, if this happens, it'll be $1 million. And I'm sitting there thinking, it could.
Yeah.
And he said, all I'm recommending of my millionaires and billionaires is that they put 1% of their portfolio in crypto. Yep. Because if you lose 1%, not going to hurt you. If it goes to $1 million, it's going to really help you. So I said, that makes sense. My portfolio goes up down more than 1% a day. Yep. I put 1% of my portfolio back when Bitcoin was like $3,000. Well, when it hit $68,000, a couple months ago, that 1% portfolio was over $1 million. 1%. So I mean, that it just shows you. But I don't think millennials should be putting 30, 40, 50, 80% of their money in crypto, and some are putting everything. That could end in tears, because it could go to zero. Like, I'm not saying it's going to go to $1 million. I'm saying it could go to $1 million. It could go to zero. I don't know. I'm willing to risk 1%, but I'm not willing to risk 70, 80, 90%.
And where it was at earlier this year was 92,000.
Yeah.
And I became a crypto millionaire. And if you sold at that time, you most likely locked in that reality.
Yeah.
But if you didn't, or people doubled down, or back down to 43,000 now, you lost half of what you put in that, and that's the big risk. So in other words, what you're saying is, if they consider putting an annuity component, they
that frees them up, Now listen, I have challenged some insurance companies. I said the first insurance company that comes out with a crypto indexed fund or a crypto indexed annuity or crypto IUL.
That's exciting.
Imagine, just imagine. And let me be on that product. I could
crypto
push
index. You know, no cap on a crypto and a guaranteed floor, that'd be insane.
Insane.
That'd be insane. When you're looking at the values and principles of saving for retirement, you did a great analogy of saying, hey, you got all these different things because you want to become a millionaire. And the seven-figure squad, people watch the YouTube channel because they eventually want to become a first-generation millionaire, first-generation cash flow millionaire. Why don't people get there?
You know, I think number one, like I said, they got to learn to make more money. You got to get really good at what you do. There are riches and niches. Find your niche, it will make you rich, all right? Get good at what you do, find your niche. Number two, spend less, spend wiser. You know, you don't have to stay at the Ritz, stay at the Holiday Inn. You don't have to drive a brand new car. Drive a car that's 2 years old. You know, do things that make sense with your money. Don't just blow your money. And then number three, put your money into things that go up in value, appreciating assets. Cars, boats, jet skis, all those things go down in value. Limit how much money you put into depreciating assets, maximize how much you put into appreciating assets. That's how you get wealthy in America.
Tom, they look at you like this guy, well-established, good-looking dude, he's rich, obviously exudes success and wealth, but you didn't obviously start that way.
I started with nothing. When I left North Dakota State, everything I owned was in the trunk of my Mazda 626, and I owed 12 grand on the Mazda 626. So I started out below zero, all right? And my parents were teachers in Minnesota. They didn't have a lot of money. Not like I inherited a bunch of money. You know, it was just hard work, and I have a very good work ethic. I mean, I work hard. For years, I was the hardest worker I knew. Now I'm not, because I'm retiring, but I'm the hardest golfer I know now.
You just translated
just
something work ethic to something else.
Yeah.
So when you got in the military, you were with us. You said you were second lieutenant.
Second lieutenant, you know.
And some guy around the barracks from MetLife was selling.
This is when I was a captain.
Oh, a captain.
Yeah,
okay.
I was a captain. I was a company commander, 7th ID Light in Fort Ord, California. And there was a MetLife agent going through my unit selling whole life. And at the time, I was a buy-term invest the difference guy. I said, who's this guy ripping off my soldiers? I said, bring him to me, because when you're a commander, you can do that. And they said, okay, sir, he'll come see you tomorrow. He wanted your birth date. I said, give him my birth date. I want to see him. He comes in, and I kind of go up and down. I'm saying, you're ripping off my soldiers. And he goes, no, sir, I'm not. I'm helping them protect their families. I'm helping them save for down payment on a house. I'm helping them, you know, with their kids' college education and giving them some tax-free income in retirement. And he said, your soldiers were nice enough to give me your birth date, so I ran a printout for you. Now, this was back in like 1987, before Tamra, Tefra, and all that. Yep. This was a 5-pay whole life. So I said, let me see this piece of crap. Okay, pay for 5 years. And then the 6th year, I got all my money back, and then the cash value's growing, the death benefit's growing. I'm looking at this thing. I said, who would ever buy term insurance when you could buy this? And he said, well, I don't sell much term. That's what I sell. Yeah. I said, you get paid to sell this? He said, I get paid real well to sell that. I said, I could sell that. And that's how I got into the business.
So there's different levels of financial education or different levels of financial awareness, because you got the Dave Ramseys of the world, you got the Susie Ormans of the world, and they're always talking about buy term, invest their friends, and he has his own term insurance company that he will refer you to as well if you want to quote. So how do we put that argument to have a different light? Because it seems to be end all be all, only buy term.
Yeah. Well, First of all, I agree with a lot of Dave Ramsey says, cut up your credit card, stay out of debt. I agree with that. But the life insurance, he gets totally wrong. And I tell people this very simply. You've been told a lot of stuff about life insurance. Let me share with you the ultimate truth, because here's the ultimate truth. The only policy that matters is the one that's in force on the day that you die. Less than 2% of term policies are ever in force on the day that you die. Now, that doesn't mean term is bad. What that means is term is there when the kids are little, when the bills are high, when the paycheck is low, you buy term insurance to get adequate coverage. But if term is your only policy, you're going to die with zero life insurance in force over 98% of the time. You can't use term to leave a legacy to your children if you're 70 and 80 years old and die. No, term's too expensive. You have to cancel it. You can't use term for some business. Can't use term for estate planning. So this whole thing that only term, it doesn't work. It doesn't work. Term only pays if you die young. And then his thing is, well, you won't need life insurance when you're older. You're going to be rich.
You're self-insured.
I can prove that one wrong, because who buys the biggest policies? Old rich people do. See, if Dave was right, old rich people wouldn't buy any life insurance. They buy the biggest policy. So he's dead wrong on that.
I think the largest life insurance policy that I've seen around was like a $235 million policy.
Yeah, and that would have had to been with like 5 or 6 different companies, because most companies won't get.
Yeah.
I don't even think New York Life goes above 50 million. Maybe they do, but I think most of the time when you get up to that level, you've got to go through 5, 6, 7, 8 different companies. Yeah.
And reinsurance after that. Yeah.
Yeah, because see, the way insurance works. It was like, when I was at New York Life and we started selling really big policies, we used to sell $1 million annuities all day long. And at first they were very scared. We don't want that. We don't want $1 million, because if that guy dies and the market's down, but once you get 10, they're okay with it. So like if an underwriter ever tells you they don't want a $50 million policy, if you brought them 10 $50 million policies, they'd be fine with it. They just don't want one. Because if that guy dies, they get fired for not underwriting it properly. But if 10 people are alive, they're not going to lose all 10. And so they have more comfort in numbers, like multiple people.
We were talking about downstairs, probably one of the greatest stories that has not been shed a lot of light on was the recovery of AIG by Bob Ben Moshe.
Yeah.
And it's one thing to take TARP money and government. There was $85 billion they took they loaned from the American people, but they also repaid it
with interest.
With interest, I think it was like $35 billion back to the American people.
Yep.
Why doesn't the coverage of the insurance industry and its brilliant executives, how come it never gets the shed of light like Wall Street
Because the media, if it bleeds, it leads, and if it's good, they don't do it. I mean, why aren't we seeing the success stories all around the country of people who came from nothing and they worked their way up? Well, they don't show that. They show, oh, this poor victim, that poor victim, this poor. We're a victim society, and so they show all the negative. They never want to show the positive. But that's what your podcast, and it shines the light on some of the positives that are out there.
Yeah, because a lot of people they swear by their 401k. And the crazy adoption is, I'm going to embrace my 401k and all the different funds that's underneath it. But they never ever introduce an annuity component. And I think only recently they started including, I think Obama even said it's from the annuity component should be in some people's 401k.
But here's how I handle the 401k. When somebody says, hey, I got $1 million in my 401k, I say, great. How much of that is yours? They go, what do you mean? It's all mine. I go, it's not yours. You got a partner. In fact, you're the limited partner. The general partner is the federal government. And you have no idea how much they're going to take from you. Like right now it's 38, 39% they're going to take. What happens when it goes to 50, 60, 70% like in the past, or up to 90% as we did in the 1950s? Yeah. The marginal tax rate was 90%. You have no idea how much of that money is yours. Why don't you put it into something that you can control, that you know it's yours? But that 401k, you have no idea how much of that money is yours. So here's what I say. 401ks made sense when tax rates were coming down. You get a tax deduction up here, it grows tax deferred, and you retire and you pay tax down here. But we know taxes are going to have to go up. So how much sense does it make to take money out of your check today, defer that baby till taxes go up to 50, 60%, then I'm going to take it out and pay? That doesn't make any sense. So what I tell people is this. You sit down with your client, say, does your company have a 401k? Yes. Does it have a match? Yes. Explain the match. Well, if I put in 4%, they match with 4%. Okay, good, I do that. That's 100% rate of return. But above the match, I wouldn't put in my 401k anymore. I would put that into cash value life insurance because I want to be in control. I want to have tax-free income in retirement. And that 401k and that IRA, those are going to be like chains around people's necks. They're going to regret that they put as much money in those products as they did. Talk to them about tax diversification. Don't put all your money in the pre-tax bucket.
Tom, you're not only talking the talk, but you're walking the walk.
Yep.
You have a bunch of annuities yourself. I think you have like 11
annuities. You got millions of cash value in life insurance.
And that's the question I want to ask you. But where's the majority of your wealth?
In cash value life insurance.
How come?
Because I want to have tax-free income and I want to protect my wealth from, lawsuits and things like that. And so that's why I have it there for, once you make a certain amount of money, what do you want to be, the richest guy in the cemetery, or do you want to live the richest life? I always ask people, I don't want to do that. Oh, you're trying to be the richest guy in the cemetery. Okay, I get it. I thought you wanted to live a rich life. I'm trying to help you live a rich life. Right. But too many people, they just think, they got to keep making. I just want to protect what I've got now.
Tom, you made a very good point on stage too as well. You said, I don't want to leave my kids money. I want to leave them
life insurance.
And why?
Because they get it tax-free. And I do it for pennies on the dollar. So I spend 15 cents on the dollar to leave my kids $1 million tax-free. I get to spend the other $850,000. So I spend $150,000 to leave them $1 million, and I get to spend the other $850,000. To me, it makes sense.
So just take a little bit of that portfolio, put it into the life insurance policy, and go ham.
And then go spend your money.
Go travel the world.
Yeah.
My wife, she sees a lot of clients, and here's some questions from her. What is the significance of an annuity in a retirement portfolio today versus 20, 30 years ago?
Well, 20, 30 years ago, it would have been even more valuable because our interest rates were 20%. I mean, can you imagine those payouts? They would have been probably 20, 25% guaranteed for the rest of your life. So, I mean, they were always important, but 30 years ago, most people had pensions. And so that was their annuity. Yeah. Now people don't have pensions. And see, a pension is a lifetime income annuity. Social Security is a lifetime income annuity. And oh, by the way, people love their Social Security, they love their pension, they love their annuities as well.
Sometimes I see people treating their annuity like a brokerage account. Like, I'm going to take out 3% or 4% from my annuity because it's got the 10% free withdrawal. Mm-hmm. In your opinion, what's the best way to, if you got a lump sum of cash, you rolled over a portion of your 401k into an annuity, what's the best distribution or income strategy to come from that?
Well, I mean, it really depends on the person. If they want to have the most flexibility for the future, then maybe they just want to make small withdrawals. That's not the way they're going to maximize their income, but it might maximize their flexibility. So I don't know their situation. Yeah. But otherwise, at some point, you should probably turn that income on for life to just guarantee that you're never going to run out, and then go out and enjoy your life. You see, what people don't understand, it is the spending of money that allows you to enjoy your retirement. It's the dinners out. It's the bottles of wine with your friends. It's the cruises. It's the trips. That's how you enjoy your retirement. I know people who got millions of dollars sitting in some account, but they don't dare touch it. Oh, just in case, just in case, just in case. That's going to do nothing for their retirement. Yeah. In fact, it causes them stress. They're going to ruin their kids by leaving them a bunch of money anyway. They should be out enjoying their life. There's
a lot of current arguments in the marketplace with the annuity strategy, in which you've been advocating for many, many years of your career. There's a very famous Wall Street guy that loves to take on a full-page ads that knocks. He said, if you bought an annuity, beware, read this or call us. Yeah. What would you say to?
Well, I wrote an article, Why Ken Fisher Really Loves Annuities, and you should too. So they can Google that, why Ken Fisher Really Loves Annuities. I wrote an article and I explained the reason Ken Fisher went after annuities. Okay, see, the dirty secret is his fees are high. He couldn't go after Vanguard. He couldn't go after Fidelity. They have lower fees than him. So he's looking around, what's got higher fees than me? Well, a lot of things do. Real estate does, options, futures, hedge funds, crypto, annuities, they have higher fees. But what could he say, what could he pick on that he could say, just sign here, sign here, sign here, move it over to me? Annuities. And he was specifically talking variable annuities. He's not talking index annuities. He's not talking fixed annuities. He's not talking income annuities. He's talking variable annuities. But he lumps it all in. All annuities are bad. No, he's saying that the variable annuities, yes, the fees are higher in a variable annuity, but they also guarantee you're not going to lose all your money. He has high fees, but he doesn't give that guarantee. And so what I say is when the market crashes, and someday it will and stays down, those people who he moved out of the guarantees, they're likely going to take legal action against him. And then he will hate annuities. Right now he loves them. He's getting rich off them. He's just getting all that money, that money. But when the market turns and these people lose money that they wouldn't have lost in the annuity, then he's going to hate annuities, I think.
I think part of the big must understand is two things. The experts, whatever you call them, they say all annuities, they can make a blanket statement without understanding that there's different segments of annuities. Just the same thing to do with life insurance. They do the same thing. What I also see them do is they say, oh, there's a lot of charges with inside annuities. And then we ask, hey, what are you pointing towards? They point to the surrender charges. So what's some of the misunderstandings of charges with the annuities?
I told my clients the surrender charge is a big positive. The only reason that the insurance company can offer you all these things, that you get this upside, you get no downside, you can do this, you can turn it into income, is because there are surrender charges. If there weren't surrender charges, they'd have to pay you 0.10 like the money market. Your money market fund doesn't have surrender charges, it's paying you 0.10. You want 0.10, no surrender charge, that's a money market fund. You want to get these benefits, they've got to have a way to know that they're going to keep that money for 5 or 6 or 7 years. It's not a negative. You can still take 10% out penalty free. You have access to money. You just, that's how these products work.
Yeah. And they don't really get
you
triggered.
You pay zero. I've got surrender charges on all my news. I'm going to pay zero surrender charge because I'm not going to surrender them. I'm going to use them the way I'm supposed to.
Yeah.
You turn it into income, there's no surrender charge.
Yeah.
You can turn that thing into income tomorrow, there's no surrender charge. So.
And sometimes people get, they get an annuity and then they listen to the stock market guys. And for the people that have they pay the 1 or 2%, whatever the cost of the income rider is. But again, well, it's expensive, and I don't want to pay atop of those fees. What would you say? Is it a beneficial benefit, the lifetime income rider?
Yeah. So fees only matter in the absence of value. The only time fees matter is if there's no value. But if that benefit is a value to them, then the fee doesn't matter. It doesn't matter if you're going to get $2,000 a month, and that's what you want, that's what you need. It doesn't matter that there was a 1% fee attached to that if it's guaranteed for the rest of your life, and you can't go anywhere else and get $2,000 a month guaranteed for the rest of your life. What difference does it make what the fee is?
Correct.
It doesn't matter.
Yeah. When you made a movie, the baby boomer dilemma,
yeah.
Right? Tell us why that was an important project for you.
Well, I mean, I was honored to be asked to be in the movie. And it's loaded with PhDs. Dr. David Babbel's in there, Dr. Moshe Milevsky's in there, Dr. William Sharp, Nobel Prize winner, Dr. Robert C. Merton, Nobel Prize winner. You got other professors from Wharton, and I mean, it's all experts that are showing what's happening with pensions and what's happening with 401ks and why a portion of your retirement needs to be in an annuity. They talk about longevity risk. They talk about it. So I was just, as one of the speakers who speaks on this subject, I was asked to be in that movie. But it's a very powerful movie. And what we've found is that if people rent out a movie theater and play it, because it's approved to play in any movie theater, that they're setting appointments with between 90 and 100% of the attendees if you do this thing the right way. And so if you go to theboomermovie.com, there's a couple videos in there that show how to do this. You can do streaming gift cards, you can rent the movie theater, you can do all different ways, DVDs, there's all different ways to get in front of your clients. But if you can have them watch that, they're going to set the appointment with you. You don't have to go hounding them down.
It sounds like a cool movie night out, because I can't remember the last time I went to the movies. I mean, it's been 2 years.
So we got some people who buy a bucket of popcorn at the dollar store. They put the DVD in there. They put 2 Cokes and some candy. They make movie night for their clients and say, "Hey, all I'm asking is that you call me when this is done and tell me what you thought of the movie." And boom, they're getting appointments.
Wow, that's a great strategy. Can you explain to a retiree the difference between the accumulation phase versus the distribution phase?
Yeah. So in the accumulation phase, you want to be diversified. You want to just, diversification, asset allocation is important. Getting a higher average return is important in the accumulation phase. But in the distribution phase, it's really all about income. It's about income and managing risk. You got to manage what happens if you need long-term care. What happens if the market crashes? What happens if interest rates go down? What happens if interest rates go up? What happens if we have inflation? What if we have deflation? You have to manage those different risks, because you could be 70, 80 years of age. You can't go back out and make more money. So you've got to make sure your money's going to last regardless of those things that can happen to you in retirement. It's about risk management and then having increasing income, because you want to have income that keeps up with inflation.
Gotcha. And the difference between getting a rate of return, right, versus a lifetime income conversion.
Yeah, well, I mean, people would say, well, what's my IRR? What's my internal rate of return? Sure. I say IRR in retirement means income reliability rate, which is 100% with the annuity. See, it doesn't matter what your IRR is. People say, well, what's my interest rate? I say, well, you got to tell me when you're going to die. I can't tell you what your interest rate is till you tell me when you're going to die. You want a higher interest rate? Live longer. You want a higher interest rate than that? Live longer than that. See, that's what I love about this. You get to set your own interest rate. But the second thing I says, the interest rate doesn't matter. What matters is how much income are you going to get for the rest of your life? because there's no other product you can buy that will guarantee you a higher paycheck for the rest of your life. And that's what matters. It doesn't matter what your IRR is. What matters is nobody else can beat this. So what difference does the IRR make? Nobody else can beat it. There's no other product, no stock, no bond, no crypto that can match what that can do.
You know, when I was taking my notes when I first started my career in 1999, and I wrote my first notes there, the biggest issue facing America today is the retirement crisis and Social Security, and this gap of the have and the have-nots. Rich are getting richer and the poor are getting poorer. Fast forward to my career 23 years later, it's even worse.
Yeah. And
there's no financial education in the schools. People are learning about money after they made many, many mistakes already.
Yep.
So how do we fix this thing? How do we help close this gap and get our country not worrying so much?
I mean, we could get into a whole political discussion, and I don't think we want to go there. But I really think the whole problem of this division in the country and everything has to do with a thing called gerrymandering, and both parties do it. They when they're in charge, they make the Republicans over here, they make the Democrats over here, so only Democrats win this district, only Republicans win this district. So what's happening is, if you think about the American people on a football field, most Americans are between the 40-yard lines. They're a little left or a little right. Okay. But because of this gerrymandering in the Republican districts, we're electing people way to the right, and then Democrats, we're electing the people farthest to the left. So we're hiring politicians that are in the end zones, but the people are here. And until you make all these territories as close to 50-50 as possible, if you could make all the election territories 50-50, then the only people who are going to win are people who can get a little bit of both. So you're going to elect middle, real people instead of wackos on the left, wackos on the right. Yeah. And that is really the political divisions in the country. The economic divisions, I mean, you know, I know one party says they want to help poor people, but from what I see, they're just helping poor people stay poor. They put them on a program, here's $300 a month, and they take away their incentive to go out and be the person they're supposed to be. Each one of us has an ability that is better than anybody else on this planet, and our purpose in life is we're supposed to find our special ability and then do that as much as possible. Yeah. But when you take that away from people and you put them in on a program, and you put them in a $300 a month or $500 a month, or hey, let's give them some more unemployment, and then they don't get a job, that's not helping poor people. That's keeping poor people poor. Yeah. But you can't say that. It's politically incorrect to say it, but it's correct. And I always worry about being correct. I never worry about being politically correct. I am correct in this, and it's just, but I don't think we're going to fix it because our politicians are in the end zones, and we're sitting here in the middle of a football field.
Well, you know, I find myself, as I've gotten older and started making more money, I've found myself being more fiscally conservative, but at the same time, there's a lot of social things I like too as well. So I'm kind of like somewhere in, I'm in between those 40-yard lines too as well.
So we need to find ways to give people a hand up instead of a hand out. And I'll give you an example. Okay. I went to college on an Army ROTC scholarship. The U.S. government, the U.S. Army paid for my college. So I guess I got a hand out, except it was really a hand up. Because look what I've been able to do with my career, and it turned into be a great investment. It turned into be a great investment for the government because I paid them far more back than they ever paid for my college, like hundreds times more. Yeah. So that's an example of a hand up. Correct. Instead of a handout. They didn't pay me money to sit on my couch and play video games and not go to work. Yeah. They said, hey, if you're willing to, study and get good grades and serve in the Army, we will pay for your college. And so that was kind of a good deal. Yeah. So we need more things like that. Yeah. That's a hand up instead of a handout. We should stop handing out money.
Yeah, because I've been part of this industry for a while. I've not touched my life insurance money, and obviously I'm still here, so my family hasn't touched my life insurance money. There's no death benefit to be issued. The money I have in my annuities, I still haven't touched. So the products of this industry hasn't changed my life in 2 decades. Yeah. But the industry has. Yeah. This economic structure we have in terms of entrepreneurship it's allowed me to become financially free, financially independent. Yep. And so when you're looking at our agency, and we're teaching insurance, we're teaching annuities, and we're teaching entrepreneurship, we find that as a blend of what we're doing. And I see the insurance industry lacking in demand. So the last question I want to ask you is, we're an industry guy. You're an advocate for our industry. We need more bodies in this field. We need more people to be helping and serving other people. What would you say to those who are in the midst of this great resignation era And why should they consider the insurance industry?
Well, I'll say this. Being in the insurance industry is a terrible job if you just want to make $30,000 a year. I wouldn't do it. I'd go change tires at Discount Tire. But if you want to make 150, 200, 300, 400,000, it's, I believe, the easiest, fastest way to get there. You don't have to buy a McDonald's franchise. You don't have to spend millions of dollars on franchise materials and equipment and property and rentals and all that, and hiring people. You can do it yourself. So I just think the entrepreneurial, if they come in with an entrepreneurial spirit that they want to be a business owner, you can make a lot of money. If you think you're going to come in and be an employee, you're going to be pretty miserable, I think. So I told my people, if you don't want to make, you know, six-figure income, I don't know if this is what you should be doing. I think you should maybe do something else. But if you really want to make six figures, I can show you how to do that.
Yeah, man, if you Google the industry most likely to make you a millionaire, number one at the top is financial services. Check it out. It's not my website. You go check out the site. So Tom, I appreciate your time, your energy.
Thank you, Matt.
If you want to find more about Tom Hegna, where can more people find more information?
TomHegna.com. I've got some free webinars at TomHegna.com/webinars. I've got that Jumpstart package. They can go to TomHegna.com/Jumpstart if you want to get a great package deal on some stuff. So.
Very cool. And for the first, what do you think? The first 10 people that drop a comment below, your biggest takeaway from Tom Hegna, we want to circle back with you because we want to get you his book, Paychecks, not play checks, right? And,
Paychecks and Playchecks.
Paychecks and Playchecks, excuse me. Paychecks and Playchecks, the first 10 people that drop a comment below. And with that being said, guys, I'm going to have Tom Hegna here from Daytona Beach at our To the Moon conference. I'm your Money Smart guy, and until we meet again, continue to live smart, continue to love smart, and be money smart today.